Chris Adams. I'm the portfolio manager of the SMID capability within the Infinity Asset Management division. Yeah, there are three key planks if you think about it, and firstly, it's all about our GARP quality approach. So we're after companies which can grow preferably a bit more than the market. They've got to have a proven business model with a management team that we're comfortable with, and an industry structure where there is sufficient growth. Because for share prices to grow, you typically need earnings growth. Otherwise, they tend to stagnate. So there's that. There's secondly, we're very big on our risk controls. Now that primarily relates to making sure that we have adequate exposure within what we consider to be the key buckets within that SMID capability. Now, within the SMID universe, which is typically sort of the X50 to around about the top 150, top 200, there are sort of 4 to 5 main risk buckets, and they include growth stocks, technology, resources, interest rate sensitive sort of stocks. What we aim to do is make sure that we sort of cherry pick the best, what we think are the best opportunities within those larger buckets. And then finally, we're a high conviction, low turnover strategy. So look, think about how you might run your own money. You're not looking to sort of buy and sell stocks every second day and take little bits out every now and again. We might only turn over 4 or 5 positions a year, and we sort of go in and out in a major way, and we're not sort of trading around the edges. Pleasingly and consistent with hopefully what I've just said, it's been a pretty broad-based contribution. So we've done particularly well in areas like gold, where although we recognise the gold price was up substantially during the year, the names that we held were substantial outperformers within that sector. That includes Vault Minerals, which was added about 6 months ago, and Gold Road, which was pleasingly taken out by its JV partner Goldfields. Now that's consistent with trying to get the best names in a sector. So, for instance, gold, it's a sector where we're never going to be too far away from the index weight. Not that we're too index beholden, but it is a highly macro volatile sector. But it's more about picking those good names. So that's been a great sector. Generally speaking, commodities have been really good for us, particularly our preferred copper names, which are Sandfire and Capstone Copper. Capstone was a new inclusion to the index earlier this year. And then mining services, which is an area which I've sort of been banging the table about for a while. We've been considerably overweight there for some period of time, and we've got a number of names within that sector. We still love the sector. It's undervalued, we think, and there's still massive opportunities. One of the reasons you want to be in the Australian market, particularly the sort of small mid-cap, is this ability to get into sort of mining and mining-related stocks, and we'd say we've got about 40% of the strategy in that part of the market. Other areas which have been great are technology. As you can imagine, we've always got an overweight to technology. Valuations at times can get challenging, but it's been a very happy hunting ground for us. Names like Life360, Pro Medicus, and more recently Superloop, which we added earlier this year, have been very solid contributors for us. So there's other names here and there, but they're probably the 3 key areas that we've added value over the last year. Broadly speaking, we don't see any reason to make any major changes. We are post the results season, and now as we go through AGM season, we are seeing the need to change a few of our other positions, and we are very busy at the moment looking at some potential new names. There's a number of industry conferences coming up. We've already had a number of meetings. We're having to turn over a lot of rocks at the moment, but we are confident that we'll come up with a few more names. We are probably looking at a bit of additional turnover as we come towards the end of the year. Basically, stocks have run hard. Valuations are challenging in some areas, and as always, not everything works completely according to plan, and there's a need to sort of replenish things. Yeah, we're not necessarily looking to reinvent the wheel, but it's more about maintaining those disciplines and consistency with the way we go about things. So, for us, we will describe our insights as both our process and our ability to assess companies. Now, whether that's management teams through our experience, we know most of the management teams really well. We know that some just aren't up to speed, and a key criteria for us is having a management team that we can rely on, not just to run the business, but to represent the business to us. So that really does whittle down the universe quite a lot. We want to be comfortable with the industry, comfortable with the track record. I mean, there's always companies sort of coming out of the woodwork, whether it's sort of military technology companies like Drone Shield for at the moment. But we're never going to be in that space. We're looking for that consistent track record of earnings and cash flow delivery. Now, we think by getting these sort of basic fundamentals right consistently, we can more consistently add value for our investors. So our sweet spot's sort of 50 to 150, 200. We can go down to the 300, but there's a liquidity slash inefficiency sweet spot within that sort of 50 to 150 where most of our positions are. And basically they're companies where we think we've got an adequate insight, but we can also get in and out of them on a time without doing too much market impact. So the guts of the portfolio is within that sort of 50 to 150. And occasionally if something really interesting pops up outside of that, we'll consider it. But normally we try to play within those goalposts. Yeah, look, we firmly believe that not only is this all-weather approach the appropriate way to invest, but it's also what clients want. They don't want a great result one year, then some difficult questions the next year. They want that consistent value add, and we also think that's the way to run it because we're trying to avoid these big sort of macro swings. For instance, if you were zero weight gold last year, your numbers would be terrible. We are seeing a huge dispersion in small mid-cap managers out there. I think it was like over 30% from best to worst. So, these are big numbers, and we're never going to be top 1 or 2. Although we've been sort of top 5 to top 10 in the last sort of year or so in an 80-horse field. So that's great, but we certainly want to avoid these sort of scenarios where you can have either stocks going to zero or the business model falling off a cliff unexpectedly. To your point, it is a volatile space. You can never know everything. You're trying to get the percentages right. You're trying to get most things right most of the time.